Well, we think Tesla represents one of the market's best secular growth stories, and that's important at a time where growth is really being hurt by inflationary impacts.
How much of a lead would you say Tesla has relative to other legacy automakers like General Motors or Ford, who have also been raising their targets on electric vehicle production over the next several years? And what will Tesla need to do in order to maintain that lead?
In this video, Tesla stock surges higher, up over 30% in the last 10 days. A Tesla stock analyst points out the extremely obvious, noting that Tesla's demand is monstrous, plus new research on battery costs and some discussion around Tesla's insane growth and the so-called competition. So let's get into it. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can get 2 free stocks with WeBull, a free stock with Stake, free Bitcoin with Coinbase, and free Bitcoin with BlockFi, and the BlockFi Bitcoin Rewards credit card. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. First order of business today, Tesla stock up another 1.5% today, closing over $1,000 per share, continuing its phenomenal run in the last couple of weeks. From its recent low closing price on the 14th of March of $766, Tesla stock now up over 30%. And keeping in mind, this was the closing price low for the day, Tesla stock actually got as low as $700 per share. Let me know in the comments below if anyone bought in the 7, 8, or 900s. A little bit of context here, Amazon stock also up today, only 0.15%, Apple up over 2%, and Alphabet, aka Google, up over 2% as well. In other words, the mega caps had a pretty good day. Now onto some comments from a Tesla stock analyst, and Clear Bull as well currently has a $1,500 price target on Tesla stock. In other words, up another 50% from where we are today, and absolutely won't be surprised to see this happen over the next 12 months. The headline here says it all. EV buyers only want a Tesla, and demand is monstrous. These comments are both fair and accurate. Quote, Tesla bull Tip Chowdhury continues to pound the table on the stock amid what he has been calling monstrous demand. According to Chowdhury, customers don't want to buy just any EV, they only want a Tesla. Absolutely spot on. The customer only wants to buy Tesla and nothing else, he said. Even Jim Cramer pointed this out recently. What was the quote? Lots of companies have EVs. Elon, aka Tesla, are the only one actually selling EVs. The analyst also again compared Tesla to Apple, saying Tesla is an experiential product, which at one time Apple was an experiential product. He said every day a Tesla vehicle feels like a new vehicle. Quote, no other company has a capability to create experiences like Tesla can. Chowdhury also highlighted news that Hertz will add Tesla Model Ys to the fleet, another sign of the monstrous demand. Interesting note on Hertz's announcement of purchasing Tesla Model Ys. We've just seen some changes to Model Y delivery dates in the United States. I wonder if that may have something to do with Hertz putting through an enormous number of orders on the website. I have literally no idea how many vehicles Hertz are purchasing, but we already know they bought 100,000 Model 3s with plans for many more to come. We also heard rumors that they could eventually end up with 200,000+ Tesla vehicles. In either case, some great points here from Trip. EV buyers do only want a Tesla, and Tesla's demand is monstrous. Now, a new note from Morgan Stanley around EV battery costs. Before we get into the note, however, I do just want to point something out that's kind of blowing my mind here. So we know Morgan Stanley have a $1,300 per share price target for Tesla stock. That's all cool. If we read the fine print here, they also have some EPS estimates, and I just want to point out a few things that to me just don't seem to add up. Morgan Stanley has their own modelware framework. That's the bottom row here. And I've circled their EPS estimates based on their modelware framework in 2023 and 2024, and they make abso-fucking-lutely no sense. Morgan Stanley estimating Tesla does $10.90 of EPS in 2023, and in 2024 just $15.20. How high are these guys? At this point in time, it genuinely looks like Morgan Stanley have divided their EPS estimates by 2 or 3. Something is not making sense. With that anomaly discussed, let's read the new research. Again, $1,300 price target. Quote, our China battery team are concerned about sharply rising input costs, especially lithium carbonate, up to a 5x increase year over year, with little relief in sight. Lower margins and or demand destruction may be on the horizon. Let me stop here. Raw material costs will be increasing. Yes, there's going to be massive issues here. This is a huge bottleneck. Prices will continue to soar for at least the next few years. This is a major problem. It will drive prices up. But at the exact same time this is happening, we're starting to ramp up volume production of a brand new technology, electric vehicles. Many, but not all, the obvious exception at this point in time being battery material costs. Many of the costs will continue to decline precipitously over time as volumes increase, economies of scale come into play, there's new innovations in manufacturing techniques and technologies. So there's a very strong counterforce to somewhat balance out rising material costs. The idea that demand may be destroyed, no fucking chance. Costs will continue to plummet on average over time with or without massive increases in material costs, in my uninformed opinion. Historically, the battery price cost curve has been declining at a pace of 3 to 7% annually. For so many years in a row, it almost seemed inevitable. But molecules don't play by the same rules as Moore's Law. What we're looking at here is effectively Moore's Law over the past 50 years. Yep. Half a century, that's it. Again, Moore's Law states that the number of transistors on microchips doubles every 2 years, and we see an extremely consistent history of this over the last half a century. We literally have a straight line. Sure, there's a tiny bit of variation, but the trend is extremely clear. Now back to Morgan Stanley's comments. I understand where they're coming from here. The idea battery costs in the past were predictably declining over time, but suddenly that's not going to take place anymore because the materials required for battery cells are not the same things that go in computers. Therefore, it's not possible that battery costs could continue to predictably decline over time in a similar fashion to other predictable cost declines, say for example, Moore's Law, number of transistors doubling at a consistently predictable rate for half a century. And while I understand where Morgan Stanley are coming from here, they're arguing that material costs are increasing, therefore that's suddenly going to stop, and that this isn't a perfect apples to apples comparison. I got a funny feeling Morgan Stanley are suffering from a severe lack of creative thinking. Yes, material costs are temporarily headed to the moon. That is a problem. I suspect, however, that we are likely to see continued and fairly consistent and predictable cost declines in batteries as production scales up over time. Now, I may be suffering from optimism-induced delusion, but I'll be very surprised if we don't see the cost of batteries predictably decline throughout the decade and beyond. Yes, materials cost to the moon over the short term, big problem, but it's only a bump along the way. It's not as big of a deal as Morgan Stanley are making out. At least, not so much for Tesla. They're already at scale, they already have long-term supply contracts, and they're so far ahead of the curve in terms of driving costs down. Everyone else, yeah, it's going to be pretty painful. Morgan Stanley spoke to their battery expert in China, and here's some of the key takeaways. Our China battery team closely tracks the cost of battery materials and other components, witnessing unprecedented increases in costs that drive inflation in battery price to OEMs. Absolutely correct. Substantially high prices may have a potential negative impact on EV demand forecasts, compressing margins across the value chain. Again, at face value, this statement is correct, it's accurate. If material costs go up and prices go up, in theory, that would have a negative effect on demand. It could also compress margins. However, if we think about this a little bit deeper, it's a little bit more nuanced than that. As I said, while material costs are going to the moon, actual production costs to produce the vehicles, which don't just include the materials, but they also include a lot of other stuff, are actually plummeting. I personally believe that the cost to manufacture the vehicles minus the actual battery cells themselves will precipitously decline over this decade by double-digit percents. I really want to make sure this point is understood clearly. Material costs going up, not great. But there's a huge counterforce, and that is the actual cost of producing EVs. It's such a new technology. 99% of the innovation in terms of the technology, the manufacturing techniques, the way to remove parts and costs and mass and so on still has yet to be done. Never mind increasing economies of scale. The more vehicles being produced, the more parts can be bought in bulk, the lower the cost, on and on and on. According to our China battery team, most LFP makers purchase lithium carbonate at spot price and have almost no long-term contract. Now, this to me is absolutely insane. This makes companies so extremely vulnerable to price fluctuations. If, as a company, you know that you have future and consistent or even growing demand for, say, lithium carbonate, and you haven't attempted to negotiate the longest possible purchase contracts at the lowest possible prices, rather instead you've just decided to agree to be tethered to the spot price, you have to be brain dead. The team believes battery makers will need to pass through inflation by raising prices by almost 25%, driving OEM price hikes as high as 15%. Again, this is totally reasonable. I do want to point a few things out. A $60,000 vehicle that increases in price by 15% is now selling for $69,000. Certainly does make a difference. However, the counterforce, once again, the company can drive the cost of producing their vehicle down by 15% in other areas. They've completely negated this temporary increase in material costs. To provide some much needed context, Tesla's original Model S back in 2012, a decade ago, cost well in excess of $100,000. Well, guess what? Today, an entry-level Model 3 is either close to or beats all of its specifications. performance Model 3 for just over $60,000 US, absolutely crushes the 2012 Model S, and it's approximately half the price. Think about that. Tesla effectively drove the cost of their vehicles down by about 50% over the span of a decade. Just some final points here. The bottom line, if EV demand continues to be strong, investors should consider that lithium carbonate supply will remain very tight and may not see prices correct this year unless demand is lower than expected. Unlikely. Adding materially to global lithium carbonate is a multi-year task. Very fair point. Negotiations between battery cell makers, material suppliers, and OEMs will determine what level of sharing of any inflationary cost pressures we see. Longer term, we see scope for more profound changes in battery technology and innovation, mass reduction, and geographic profile of the supply chain to address material volatility and supply chain sustainability and security. Jesus, that was a mouthful. On a relative basis, we believe Tesla's scale, technology, and vertical integration make it better positioned to address these significant supply chain challenges relative to many other EV makers under our coverage. Absolutely agree. Tesla will be the least affected company by miles. Of course, there's also the added bonus that Tesla has effectively increased the price on their vehicles in the last 12 months by up to 20, 25, even 30%, meaning that even if their costs were to surge by 15%, they've already got a built-in buffer to account for that entire increase. Why? Because they had to increase the price of their vehicles so much because demand's insane and wait times are ridiculous. Tough problem to have.
Well, today marks the 2-year anniversary of the pandemic-era low in the stock market. That was on March 23rd, 2020, when the S&P 500 closed at 2237.
Who remembers peak fear? I sure do. In fact, I was making videos at the time trying to tell people to calm the f*** down, explaining here's what I'm doing, here's what I'm thinking, here's my reasoning, here's what I predict happens, all of which aged exceptionally well. In fact, on screen now, I was buying, putting my money where my mouth is, literally picking up Tesla stock at bargain basement prices. I dropped about $25,000 in March 2020 in Tesla stock, now in excess of $250,000. Solid 10x in just 2 years. Not bad. Let me know in the comments below. March 2022, when the stock market was imploding, people were fearful, uncertain, doubtful, they didn't know what was going on, they thought it was the end of the world and so on. What were you doing? Were you panicking? Crying in the corner, asking for daddy to hold you? Did you panic sell any stocks? Did you dump everything? Did you short the market? Or did you go shopping and pick up some of the best bargains in the last decade?
Since then, the broader market has rallied, but the best performing stock over the past 2 years has been none other than Tesla, up more than 1,000% over that period. Here to discuss this and more is Garrett Nelson, CFRA Vice President and Equity Analyst. Garrett, thanks so much for joining us. I know we want to touch on Tesla's latest news out of Germany, but first, on this just meteoric stock rise and outperformance even for the year to date, what do you think has been going right for Tesla to catalyze this move?
Sure, thanks for having me. Well, we think Tesla represents one of the market's best secular growth stories, and that's important at a time where growth is really being hurt by inflationary impacts. This is a story that's not immune to inflation, but the growth is really being driven by company-specific factors. The growth for electric vehicles and also the startup of 2 new factories, one in Germany, they just held the ribbon cutting, and then in Texas, where they have a grand opening scheduled 2 weeks from now. So, these are the reasons why we upgraded the stock from hold to buy in early January, because they're entering really a new growth phase with the startup of these 2 new factories that will increase their annual vehicle production capacity dramatically. And so that's what's really driving the earnings growth going forward.
And Garrett, on top of that, we're also seeing that Tesla may have plans to double down in China to meet demand. What is the strategy there? And then against that backdrop where you have the Russia-Ukraine conflict, now obviously with this manufacturing facility in Germany, and then you have some of these COVID production shutdowns in China as a result of some of these outbreaks there. Yeah,
their strategy really is to do what they can to increase production. They have a goal of increasing their annual auto sales from about 500,000 vehicles sold in 2020 to 20 million by the year 2030. So that's a growth of 40x that needs to happen. And so they're going to have to really accelerate their growth by building new factories. The Texas and Germany factories essentially doubles their number of operating factories from 2 to 4. And we believe they're looking at other factories around the world. And so this increased geographic diversification is really going to help Tesla's growth in other markets and achieve economies of scale, which should help drive down their costs.
Absolutely spot on. And I don't think most investors are truly appreciating how much economies of scale will come into play in terms of driving Tesla's costs down. Tesla is already a money printing machine. Just a few years ago, this was not the case, but we're still in the first innings. As Berlin and Austin ramp to scale, as Shanghai continues to expand, as Tesla continues to squeeze out more incremental capacity from Fremont, as Tesla continues to innovate in manufacturing, in technology, they're going to continue to drive the cost of their vehicles down considerably. And given the fact that demand for Tesla's vehicles is truly insane, rather than Tesla passing those costs on to consumers, at least for the next few years, it looks like Tesla's going to be able to continue selling vehicles for similar prices, maybe even continue to be forced to raise prices over the short term, which means many billions of dollars of additional profits per year because they've been able to continue to drive their costs down massively. For the record, there are no other electric vehicle manufacturers on Earth producing the same volume of vehicles as Tesla. Tesla is at the largest scale of any EV maker on the planet. This means they have a huge competitive advantage in and of itself, just the fact that they benefit more from economies of scale. If that was the only differentiating factor, Tesla would still have a huge advantage. But that's not the only factor. They've also got the best engineers, the best technology, blah, blah, blah.
Garrett, we're of similar age. Usually not much good comes from dancing at our age, but what did you think of his dance moves yesterday in Germany? And can he meet these goals of 500,000 vehicles a year from the Gigafactory?
Sure. Well, on the first part, on the dance moves, I don't recommend he go on Dancing with the Stars anytime soon, but I'm not sure he's been invited. As far as their initial production goals from the two factories, we view them as very achievable. The auto industry is really struggling with chip shortages and supply chain issues. And so, these are more modest goals that we think are achievable. Tesla has become very good at setting investor expectations. That's why the company has now beat earnings 9 of the last 10 quarters. So
now, to be fair, Tesla didn't beat earnings 9 out of the last 10 quarters. Wall Street missed Tesla's earnings. They massively underestimated the company. That's an important distinction. But basically, the last 3 years running, Wall Street has considerably underestimated Tesla, quarter after quarter after quarter after quarter, yet they haven't learned from consistently underestimating Tesla in the past. When will they finally learn their lesson, if ever? Let me know in the comments below.
We think that 500,000 unit goal is achievable, and over time they can really scale up. With these larger factories, it really takes time. It's a several-month process to scale up to full capacity, and at the time where the entire industry is suffering with raw material shortages.
How much of a lead would you say Tesla has relative to other legacy automakers like General Motors or Ford, who have also been raising their targets on electric vehicle production over the next several years?
I'll take that one, Emily. As far as Tesla's lead over companies like General Motors and Ford, well, let's rewind the clock to 2011, when Elon Musk stated this about Tesla's future ambitions and leadership in terms of electric vehicle technology, quote, "Second place should need a telescope to see us." Well, Elon, more than a decade later, second place sure fucking does need a telescope to see Tesla. In fact, I don't even think the James Webb Space Telescope will be powerful enough to see you from second place. So, how far ahead is Tesla? Embarrassingly far, and that's putting it lightly. By the way, shout out to the power of having clear goals. Elon Musk, 2011. Second place should need a telescope to see us. Fast forward a decade, and that is the exact situation today. This couldn't have been clearer. This wasn't, we should be further ahead of everybody else. We should have a strong lead. A fucking telescope. Yet here we are. I guess this is another big tick for Elon Musk delivering on one of his goals.
And what will Tesla need to do in order to maintain that lead?
We view Tesla as having an enormous lead over all the competitors, and it's why the legacy automakers have been announcing huge increases in their investments that they're dedicating toward electric vehicle growth. You really saw that in 2021 with some major announcements. GM, Ford, Volkswagen, and others dedicating a lot more resources to growing because everyone's playing catch up with Tesla, and it's going to be very difficult to really compete with them longer term because Tesla has a huge cost of capital advantage over competitors, so they can fund growth of new projects very inexpensively. They're the largest automaker in the world by market cap by a wide margin. despite not even having a fraction of the annual sales that some of the larger automakers have. So that's where we think Tesla really has an advantage. And also they're doing a lot of internal R&D, and we think it really shows up when they talk about their battery technology and some of the innovations that they're making. They're dedicating a lot more resources to R&D, in our view, than a lot of the traditional automakers are.
And speaking of traditional automakers, obviously we saw Ford and perhaps other car makers may follow suit in splitting into two distinct businesses, one to focus on their combustion engines and one specifically for their EVs. How much of a difference will that make if more companies get on board with this?
Yeah, so what's really driving that is Tesla, because you have a company, valued, north of 100 times earnings, and then you have traditional automakers, which many of which are still trading at PE multiples, in the high single digits. So there's just this huge valuation gap between Tesla, who's valued really like a tech company, we think appropriately, and legacy automakers, and the auto manufacturing business is a very difficult one. So that's why they're splitting their businesses. That decision from Ford, to actually split the results of the electric vehicle business versus the internal combustion engine business. I think it's also a step that they could be taking to make a spin-off easier. And we think that will happen probably in the next couple of years. You'll probably see that from Ford.
Completely agree. I've discussed this in detail in the past. This is the play. For legacy automotive manufacturers, the best move forward is to spin off your EV business eventually. In the interim step, you've got to separate them and blah, blah, blah. It's a bit of a process. But the idea, put the EV business on the life raft and get the off the Titanic. Hope you guys and girls have enjoyed the video. And finally, don't forget, sign up to Patreon with the card in the corner or the link in the pinned comment to gain instant access to over 100 exclusive Q&A videos on every topic you can imagine, plus instant access to my Tesla stock price targets out over the next decade in the bear case, the base case, the bull case, and the hyper bull case. I'll see you over there. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you enjoy these videos, there's a bunch of ways you can support the channel, access exclusive content and perks, and get some free stocks and crypto. Check out the links in the pinned comment below. You can get 2 free stocks with WeBull, a free stock with Stake, free Bitcoin with Coinbase, and free Bitcoin with BlockFi, and the BlockFi Bitcoin Rewards credit card. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. If you want to take it to the next level, join thousands of members on Patreon to gain exclusive access to over 100 Q&A videos, loads of exclusive content, exclusive access to my up-to-date 10-year Tesla stock price targets, and even access my Tesla valuation model at the investor support level and above. So check out the links in the pinned comment below, and thanks for your support. And if you're still watching, you're awesome. I read every single comment on this channel and I really appreciate your feedback. So if you've got any thoughts on today's video, questions, comments, or suggestions for a new video, let me know in the comments below. Check the cards on screen now to browse the merch store, join Patreon, or watch the next video.